Welcome, everybody. I'm excited to share this presentation with you. I want to thank Fred and Tracy for allowing me this platform to share my knowledge based on years of mistakes and some successes. And yeah, this is going to be a fun one. So let's get started. All right. So, is mortgage note investing actually passive? I am Jamie Bateman. Obviously, you're watching the seventh annual Cash Flow Expo. And once again, I want to thank Fred and Tracy for allowing me this opportunity to present to you this topic. Is mortgage note investing actually passive? A lot of the gurus out there say it is. They talk about mailbox money, passive income, with mortgage note investing compared to the headaches of tenants, toilets, trash, blah, blah, blah. Is that true? Well, toward the very end of this presentation, I'm going to give you the answer. We're going to build up to that, so stick with me. As a disclaimer, none of what I say here is to be considered legal or financial advice. None of this is advice in any way, shape, or form. It's just for informational and educational purposes only. I'm not an attorney, an accountant, or a financial advisor, and I'm not pretending to be. This information is not intended to be a substitute for legal or financial advice that can be provided by your attorney, your accountant, and/or your financial advisor. Here's a whole bunch about how awesome I am. Um, Kidding, but feel free to pause this, read it. Um, just by way of a little bit of background, I've been an active real estate investor since 2010, primarily focused on residential real estate. Started out doing buy and hold residential rental properties using the Burr method and primarily in Maryland at that point. And now I've got rental properties in a couple of different states. In 2018, I switched my focus from rental property investing over to mortgage note investing. Still do both, but 90% of my professional focus is now on mortgage notes. I was able to quit my W-2 job a few years ago, and there's a little bit more about me there. Like I said before, I've made a lot of mistakes, and in mortgage note investing specifically, I have a good amount of experience with both uh, the extreme passive and extreme active sides of it. So that gives you a little hint there, as well as everything in between, a lot in between, not everything, but a lot of the different options in between. So mortgage notes have a lot of benefits, and we're going to find out if it's truly passive or not. So the spectrum of passiveness in note investing. Note investing offers a spectrum of passiveness ranging from passive to very active, very passive to very active, I should say. So we're going to cover different options and strategies along the spectrum. We're going to get pretty granular here, but obviously we don't have time to go into all the details of each strategy. And that's where you can reach out to me or others to find out more. So, I do mentoring for some active mortgage note investors. And one of the things that's really important to define upfront for these investors and myself and anyone else who wants to get involved in mortgage note investing is, what are you trying to get out of this investment? So what do you want it to do for you, right? So do you want cash flow? Do you want a lump sum of profit in a few years? What are your, what do you want it to do for you? And that's really, really important before you jump in. There's so many factors here to consider when you're defining your objectives with regard to mortgage note investing. And it's really important that you understand your goals. Like I said, the goal, really, what do you want this thing to do for you? Because mortgage note investing is one strategy among many within just real estate investing, just residential real estate investing in particular. Um, It's not the only strategy. So maybe it's not right for you. So define your goals. What do you want it to do for you? And other things to consider before you just jump into this are what's your experience? Where does your experience lie? I see a lot of different backgrounds coming into the mortgage note space. Example, real estate agents, fix and flippers, wholesalers, people with a lot of residential real estate experience, which can be highly valuable. That said, there are plenty of people who do well with mortgage notes who have, an engineering background. Maybe they love kind of the crunching the numbers or um, software and systems. And then you have people who have more of a financial background, who obviously might want to deal with the numbers more. Maybe it's just they're in sales. There's so many aspects of this that can help you do well. So many parts of someone's experience that can really transfer over to success in mortgage note investing. And nobody has it all figured out. There's art and science to this. So I think not only do you need to sit down and understand what your goals are for this or what you want mortgage note investing to do for you, you really need to understand where your strengths lie and kind of focus on that to get started. Um, Other things to consider before you jump in. And when I say jump in, we're going to get into the weeds on ways to jump in and whether you should jump in, more of an active or more of a passive way. Um, but other things to consider is your one more thing is your tolerance for risk, right? Are you willing to put X dollars at risk to go to zero? Some people can't sleep at night doing that. Other people are completely fine with that. And maybe, so that's an element you need to consider. And so different ways, to approach this as far as what you want note investing to do for you would be considering one way would be considering this note investing just to be a way to diversify your portfolio. Maybe you're an experienced active or passive investor and you have a lot of experience with real estate, crypto, stock market, et cetera, but maybe you want something that's a little lower on the capital stack, comes with a little less risk, a little more security, a little less upside, and you just want to diversify. There are many ways that mortgage note investing allows for diversification within one's portfolio, and especially if you get into note funds and different things like that, you can really diversify that way. Do you want this to be more of an active side hustle? Maybe you're a high performing, W-2 employee and you have no plans to quit your job. Don't have a ton of time, but maybe you're younger and you have a lot of energy and don't have a family or something, and you want to start a side hustle and just see where it goes. Mortgage note investing can be a great way to do that. And then maybe you have more options down in the future. I personally am a passive and an active investor. And so there are benefits to each, and kind of did start out as a side hustle. And then I was able to quit my W-2 uh, using both rental property income and mortgage note income. Scaling a note business, I don't necessarily recommend you just rip off the Band-Aid and quit your job if that's where you are and just jump into starting a note business. But maybe that's your end goal. Maybe you want note investing to supply you with full-time income. Well, transitioning into a large-scale note investing business is certainly an option, and we're going to get into that and the kind of the three legs of the stool for that. Like I said before, understanding your risk tolerance is critical. So understanding your comfort level with risk, and that can really help you determine your investment strategy. Um, it really your appetite for risk, and a lot of this is very personal, and that's one of the reasons I don't love the one size fits all approach to this. I highly recommend note investing courses, note investing membership groups, uh, things like this Cash Flow Expo for sure. But at the end of the day, your journey is going to be different than everyone else's. And so you really need to, personalize your approach based on your experience, your goals, and your risk tolerance. But don't forget about risk tolerance. It's a critical piece. All right, so the moment you've all been waiting for, the spectrum of passiveness when it comes to mortgage note investing. Um, we're going to go through 5 kind of levels of passiveness within mortgage note investing. And I've got experience in all 5. Um, I'm not an expert on everything within mortgage note investing. There's so many different creative ways to approach this. I'll never learn everything when it comes to mortgage note investing. And that's something that I really enjoy, actually. There's always more to learn. But if you do have specific questions later on, don't hesitate to reach out. So number 1, very passive, investing in a mortgage note fund. Um, we're going to get into the details of that in a minute here. Rather passive, hypothecation, which is really just a fancy word for lending money using a mortgage note as the collateral. Purchasing partial note, not a whole note, can be a rather passive way to approach mortgage note investing. And then partnering in a joint venture or multiple joint ventures as the quote unquote money partner is another rather passive way of doing mortgage note investing. Somewhat passive would be purchasing performing notes. Um, Buying 1 or 2 truly performing notes can be somewhat passive. There's a little bit of work, but it's not quite as passive as investing, buying shares of stock, right? It's really not as passive as buying stocks or bonds or investing in a mortgage note fund. Um, there's some active management involved. But truth be told, you can buy a couple performing notes and manage that probably, putting in 1 hour per week. As we move down the scale here, the spectrum, we move into level 4, rather active. So purchasing non-performing notes. This is, going in with the knowledge that what you're buying, the asset that you're buying, the borrower is not paying. And so there's going to be some work involved in working that out, whether that's through the borrower or through the property. And then secondly, with this rather active level 4 is creating notes. And I know Fred and Tracy have a lot of experience in that realm. Very active level 5 would be managing joint ventures. So where you're not the money partner per se, and you could be putting in some money. There are many ways to structure JV agreements. But where you're the day-to-day active manager, and if you're scaling that on any level, there's work involved, and it's very active, dealing with foreclosures, different states, possibly bankruptcies, different vendors, servicers, et cetera. It's really critical that you're quite hands-on with that approach. That's not mailbox money. And then managing a fund is certainly very active. We're getting it into all of this in a little bit more detail. All right, so level 1, very passive, investing in a note fund. I don't really know of a more passive way to be a mortgage note investor than to invest into a mortgage note fund. I have managed 2 mortgage note funds. They're smaller compared to a lot of bigger funds out there, but I'm very hands-on with regard to managing those note funds. So I do have a good bit of experience in speaking to this. I've also invested as a passive investor in numerous mortgage note funds. Some note funds are, there are many ways to structure note funds. But some of the benefits in with regard to investing as a passive investor, again, we're speaking about passive investing here. Some of the benefits to investing in a note fund are that, in today's uncertain economic climate, you may be seeking an alternative strategy that will provide stability and income. Okay. So a mortgage note fund can really be a compelling option here. You're not dealing with property ownership. You're not dealing with managing of the notes. You're not dealing with managing of investors. In an ideal world, you're putting your money into a note fund and you're getting hopefully a monthly or quarterly deposit into your bank account, or maybe it's a self-directed IRA or similar account that you're investing through. Minimal day-to-day involvement, potential for strong returns, and also diversification. Again, note investing, especially first lien, if you're buying first lien mortgage notes or investing in a fund that buys first lien mortgage notes, and they do a good job of buying those notes at the right price point and working through the right due diligence process, you're really pretty low on the capital stack. So nothing is risk-free, but this is a great way to, provide passive income. You're probably not going to compete with some of the other alternative investments with regard to returns, the level of returns, but it's pretty low in the capital stack, meaning it's a fairly low risk opportunity, relatively speaking. So I alluded to the fact that some different funds are set up differently. You can get into all kinds of different approaches. The most common funds are Regulation D, 506C, or 506B. And the two funds I have managed are 506C, which are for accredited investors only. And you can look that up. What does that mean? And I can advertise and talk about the specifics of the funds and the offering. Whereas the 506B is what people commonly refer to as a friends and family fund. And so that type of structure you cannot advertise for. You need to have a relationship as the fund manager with the passive investors. And you know, I should have caught this on the slide. Just because you're an accredited investor does not necessarily mean that the fund has a more substantial minimum requirement. It just means that it's a different fund structure. So each fund may be, my fund, my current, the Integrity Income Fund that's currently open, we have a $25,000 minimum investment. Again, this is for accredited investors. I'm not here to plug my fund. I'm just using it as an example that I know well. Also, we have in that same fund, if you put in $100,000, you're going to get a higher targeted return. But you must be an accredited investor to invest in that fund. There are plenty of other options. Chris Seveny, for example, I'm not plugging his fund or any particular other fund, but he has a Regulation A fund that is open to both accredited and non-accredited investors. So you really need to figure out, what type of fund structure you're interested in investing in if you decide to be a passive investor in a note fund. It's really important to do due diligence on the fund itself, and especially the fund's operator and management team. So again, investing in a fund as a passive investor can be a great way to achieve diversification without needing to learn really the intricacies of mortgage note investing and without having to put in the time on a day-to-day basis that it takes to manage a note fund and manage assets. We're going to get into the details of what that does require later on. So it can absolutely be a great way for passive income. And but again, even as a passive investor in a mortgage note fund, you still need to know what you're looking for. Are you looking for a monthly, deposit into your bank account as income, or are you looking for potential upside down the road? Both are passive, okay, but they don't necessarily achieve the exact same thing for you. All right, a mortgage note fund. All right, so just on a basic level, what is a mortgage note fund? A mortgage note fund pools investor capital to purchase mortgage notes, the debt that's secured by residential real estate in this case. So instead of owning physical property, you invest in the loan itself, but you're actually investing in multiple loans that the fund is buying, and earning income or profit through the interest paid by the borrowers, as well as the profit if you exit the deal. So the point is, a mortgage note fund is you're taking capital from passive investors. They're putting that capital into the fund, a pool of money, and the manager of the fund is going out and buying mortgage notes and actively managing those mortgage notes, as well as the investor capital. Buying at a discount, creating opportunity for passive investors. Um, how mortgage note funds work. You can read through this. I'm not going to read every word. Again, we talked a lot about this already. The manager of the fund is acquiring mortgage notes, selling mortgage notes, exiting mortgage notes through the borrower or the property, and buying them probably across many different states. We've purchased in about 30 states. I don't have the exact number. That's one of the benefits of mortgage note investing is that you can do it from anywhere. And then a fund also requires a high level of management. And so as the passive investor, you're not doing that management. You're giving up a lot of control, you're trusting the operator, and you're you're not doing any work, a very minimal amount of work. You're getting hopefully some income and or profit, and then a K-1, and you file your tax returns, and you go on your merry way and spend your time how you want to. You can see the rest of the slide there. So benefits of a mortgage note fund: passive income, real estate-backed security, portfolio diversification, high potential for returns, professional management. So it's really hands-off, hence passive. And again, one thing that's could also be highlighted on here is that it's pretty low on the capital stack. That's mortgage notes in general. But you're diversifying, because you're putting your capital in, and then the note is buying assets, fairly lower risk assets that are across many different states, across many different borrower types. So if one note goes south and say that the note fund loses money on one note, hopefully the other 25 or 50 or 100 notes in the fund make money. And so, your return is potential for high returns is a little bit limited, but your risk is also mitigated some there. Level 2, rather passive strategies. All right, hypothecation, purchasing of partials, and then joint ventures as the money partner. Won't go into too much detail here because we are a little bit short on time. Hypothecation is essentially taking a note and pledging that as collateral. So if you're lending as the hypothecator, we'll say you're lending someone like me who goes out and buys mortgage notes. You're lending me money to go buy additional notes or whatever, honestly, whatever I need for my business operations. But I'm pledging an existing mortgage note that I own. This is how I've done it in the past. And I'm borrowing your capital as the quote unquote rather passive investor, and pledging that note that I already own that as collateral. Okay, so there's a borrower and a lender with regard to when it comes to hypothecating notes. I do have a blog post on my website that goes into detail about the difference between hypothecation and partials. When you're purchasing partials, it's a slightly more active strategy than being a lender through hypothecation. They're very similar. When you're truly purchasing a partial, you're buying X number of payments. Okay, so I might own the whole note. Let's say it has 200 payments remaining, and I sell to you 50 payments. Well, now you're in charge of managing that note, dealing with the servicer, potentially having to do foreclosure and other things. But in an ideal world, this is a performing loan that you're collecting payments on. It's still rather passive. And you own that note for X number of payments, or you're due that number of payments. I still, as the whole note owner, have some interest in how that note does, but I'm not actively having to manage that note while you own the partial, if that makes sense. So it's a little bit more active than being a lender on a hypothecation, but these are both rather passive strategies. When it comes to joint ventures, which I've done a bunch of, personally, I think joint ventures work better for non-performing loans than using a performing loan for a joint venture. And I can get into the reasons why. But as the quote unquote money partner, in a joint venture, it's still rather passive. You're making big decisions along with the day-to-day manager typically. So you might meet monthly or quarterly or just when something arises, a big decision arises to decide together how you want to move forward with regard to the note. And I'm framing this right now as a joint venture on one particular deal. There are plenty of other ways to do joint ventures. You can do a joint venture on a much larger scale. But we're framing this for discussion purposes as two people go out and buy a note. One's the money partner and one's the operational day-to-day partner or manager. So as the money partner in a joint venture, you're not, it's rather passive. Level two, rather passive. You're getting updates, you're getting hopefully money back, hopefully a profit. But you're not making the day-to-day decisions. You're not dealing with the vendors. You're not choosing which servicer, to deal with or which attorney to deal with. You're not making, putting together loan modification options for the borrower, et cetera. It's rather passive. And you can see the advantages of all three of these rather passive approaches listed there. Again, just to highlight, hypothecation and partials are very similar and they work really best with performing or reperforming loans. Whereas in my opinion, joint ventures work better with NPLs, non-performing loans, because there's a clear exit point, whether that's through the borrower or the property. So somewhat passive. So we had rather passive and now we have level three, somewhat passive. So this is slightly more active. All right. This is kind of middle of the road, if you will, with regard to the spectrum of passiveness with mortgage note investing. So I believe this is our only, yes, this is our only level three approach. So purchasing performing loans, performing notes. You can see here that finding sources of notes, and that's the $1 million question people have. Where do I find these notes? And that's, continues to, that's always a work in progress. You're never done with regard to developing sources. So it's a relationship business and your reputation is critical in this space. But finding sources of notes is really important and it takes a lot of work. So again, we're getting more and more active with regard to the order in this presentation. So defining your criteria. This is really important. When I work with mentees in my mentorship program, a couple of things we do right away. And again, everyone's situation is different, but if you do this enough, you come across a lot of patterns. And one of the things that we often do right away is define your buy box. Okay, so defining your criteria. What are you looking for? Are you looking for firsts, seconds, CFDs, HELOCs? Are you looking for vacant or owner-occupied? Loans on vacant or owner-occupied property? Are you looking for, what's your buy box? What states do you have relationships in? Do you have a good attorney somewhere that, can help you? Do you have boots on the ground somewhere? Do you have specific knowledge geographically somewhere? Are you, can you have your capital tied up for 3 years and maybe you're okay buying in a judicial state like New Jersey or New York? Do you need a quick exit? Or are you looking for cash flow? Do you have licensing? It's a lot of questions that will go into defining your buy box, but it's very important to actually define your buy box because if you don't know what you're looking for, nobody can help you. All right. So it's very important that you know what you're looking for. If you change every other day what you're looking for, I can't help you. So, define your buy box and repeatedly put it out there. This is what I'm looking for. These are the types of notes that I need. Due diligence is the second thing I'd say that we really spend a lot of time on upfront. We do focus on finding sources. That is true, but I'd say number 2 and number 3 here are critical because the finding sources is ever changing. But creating your due diligence process, and when I work with mentees, it's not a copy and paste of my due diligence process because yours might be different, but it's extremely important that you're doing due diligence on the asset, the borrower, and the property, as well as the seller. That part gets missed often, the note seller. doing due diligence on that person or entity is critical. So we're often spending a lot of time building out, our due diligence checklist, and it's very easy to miss a step if you don't have an actual checklist that you go through each and every time. It could evolve, it could change, you could use different vendors. Maybe you love BPOs for a while. Now you think they're a waste of time or a waste of money rather, and you just want to get a cheaper property valuation report. That's fine, but you need to actually use your due diligence checklist and follow your process. Building a support team of attorneys, servicers, and title companies, and among many other types of vendors, is critical. And it's, again, you're never done, right? So it's always changing. One attorney may be great this month, and then he or she retires, or they just stop responding. And, attorneys are people too. So life happens. So you can't just say, I have a great attorney list, I'm good forever. No. Planning your exit strategies, and ultimately, you don't always know how the note is going to turn out. But if you're buying well, you don't really care if, you have options, and you should be able to make a profit if you didn't overpay. So again, this is level 3, purchasing performing notes. It's somewhat passive, but we're getting a little more active here. So start buying 5, 10, 15 performing notes. Some of those are going to go non-performing, and you still have to, even on performing notes, you still have to manage, actively manage your portfolio. So it's not extremely passive. So rather active, level 4. All right. So this is for somebody who really has more time, probably you may or may not have good amount of capital to work with, but you've got time and energy that you want to put into being a mortgage note investor. And again, you tell me, is this mailbox money? I don't know. So characteristics when it comes to non-performing notes or non-performing loans, the borrower is behind, typically 60 to 90 days behind, is considered delinquent. Often some of this is state dependent, but 90 days is kind of like the mark where you can really start to pursue foreclosure. You may buy sub-performing notes. Just people always want a black and white answer. Is mortgage note investing passive or active? Can be passive, can be active. And stick around, because at the end I'm going to show you how active and passive investors can work together. That's a really critical piece of this presentation. But borrowers are behind in either sub-performing or non-performing notes. They're not making their mortgage payments on time. That can take on many different shapes and sizes. The challenges with it, you're working with borrowers potentially to get the loan reperforming. Maybe you can modify the loan, raise the principal balance, and get that thing reperforming. Now you have a reperforming note with a higher principal balance, which is what a note buyer largely bases their pricing on. You just added value to a non-performing note that you could sell for a profit, or you could keep it for cash flow. Or if you can't work something out through the borrower, you're going to end up exiting through the property if you don't sell the note as an NPL. So there are a lot of challenges and a lot of work involved with regard to managing NPLs. But again, there are opportunities for higher profits by turning non-performing notes into re-performing notes. And this is where creativity and experience and talking with other investors really comes into play. Note investing is not just a science. There's a human element. There's a story behind every borrower. There's a human element to every note. So there's an art to note investing, and that's what can kind of keeps it fun and fresh. And again, you exit through the property or the borrower, as I've said, or through the loan if you just sell the loan again. The loan that you just purchased, that's another way to exit. But ultimately, you're exiting through the borrower or the property if you're not selling the note. One of the things I like to point out is that buying performing loans is more like investing in a cash flowing rental property than it is many other strategies. So what I mean is buying a performing loan, although very different from buying a rental property with regard to tax income tax considerations, etc., you're buying that for cash flow. Okay. Whereas a non-performing note, you're buying that at a greater discount and you're trying to add value to that note or that asset. With a performing note, you're just holding that for cash flow. There's not a lot of opportunity to add value. That's like a rental property. The note itself is probably not going to go up in value unless something drastically changes in the market conditions, whereas a rental property can over time. But there's not opportunity to add value there. Whereas with a non-performing loan, an NPL that's got problems, what do problems bring? They bring opportunity. So as indicated here on this slide, you have an opportunity to add value to a non-performing loan. That means you can add that's an opportunity for profit in your pocket, but there's a lot more work involved than dealing with performing loans. So, and also you're not getting cash flow. Okay. So you need to be okay with, if you're going to get involved with non-performing loans, yes, you can mitigate some of that risk by buying at a discount and not putting, higher dollar amount at play here. But there's no guarantee you're going to get anything back at all. But if you do make a profit and you do get your capital back, it can take years. So that's much more like a fix and flip on a property. And I would actually add probably double the amount of time, maybe triple the amount of time it takes on a fix and flip. And when with regard to exiting a non-performing loan. So if you can do a fix and flip on a property in 6 to 12 months, an NPL might take 1 to 3 years to exit. I've had longer than that. So just know that performing loans are more like a rental property for cash flow. And then NPLs, they're more like a fix and flip. It's a lumpy profit that comes your way. You're not getting paid every month. So that's really important to understand. So another level 4, rather active strategy would be creating notes, originating notes. I feel like I know a lot in the residential real estate space, investing space. There's always a ton more to learn. There's so much to learn, but compared to what I knew 10 years ago, I know a lot. I will tell you, originating notes is not my wheelhouse. That's just not what we do. But these are some steps that you can see here. If you can purchase a property with cash at a discount or even not with cash, rehab it, you're adding value to the property, find a buyer, and then you're underwriting a loan that's compliant using RMLO and hopefully a title company. And then you can sell that note to other investors down the line. So the point is that this is not a passive strategy. Okay, this is rather active, just like this rather active strategy of buying non-performing notes, creating notes. And this is not the only way to do it. This is just one way with these 5 steps. Creating notes is definitely a rather active strategy. And so it's not passive. There's a lot of work, as you can see on this slide. All right, level 5, very active strategies. This is our final level here. We have 2 approaches within the very active approach, or strategy, if you will. First approach is managing joint ventures and buying non-performing loans. So what I mean by this is, and this will be more clear on the slide that's coming up, but you're the active day-to-day manager of these non-performing notes. And so you are not the money partner necessarily, but you're the person managing, putting in the work, the day-to-day work. This takes legal contracts, regular reporting, and balancing deal timing with funding. So, if you're trying to scale this on any real level, that's a lot of work. And frankly, I found that switching over to the fund model, I've done a bunch of partials, hypothecations, managing of joint ventures. ultimately, I decided to move over to the fund model just because it made a lot more sense for me as an active manager. But if you maybe you have 5 hours a week to put into this, 10 hours, and you just want a handful of JV deals that you're doing on a deal level basis, meaning one asset equals one joint venture, you can do that, probably 5 or 10 hours a week. So, but if you want to scale it, it's very active. Again, joint ventures, in my opinion, work better for non-performing loans. So not only are you managing someone else's capital, but you're also managing non-performing loans, which we've already indicated are not passive. Uh, Managing a fund really involves three things. Okay, it involves, well, we'll get into that, but you can see it's like we talked about earlier. You're pooling capital from passive investors. So back to joint ventures. This is an overview of joint ventures, and again, you can read through this. You know, yeah. So you can read through the best use case where it's NPLs. In my opinion, I know people do non joint ventures with performing notes. People sell partials on NPLs. Um, you know, Personally, I found that NPLs work better for joint ventures, or I should say, joint ventures work better with NPLs, and then performing notes work better with if you're trying to do partials or hypothecation. So, again, many different ways to legally structure joint ventures. Uh, Always have an attorney review everything. Don't just wing it or use a contract you found on the internet. But if you're scaling this and you're managing 25 different joint ventures and you're doing, say, a quarterly report to each, money partner, that's a lot of work. That's a lot of work. So is that passive? No. Managing a note fund, as I've said, I've managed two different funds. One is closed and one is open, the Integrity Income Fund. And I completely stole this from, I think, Dave Van Horn, who, I don't know if it was his original idea or not, but managing a note fund, there are three legs of the stool. Okay. One is raising capital. You need to have money to go buy assets, to buy the notes, right? So that's kind of the point is you're gathering other passive investors' capital to put that to work and hopefully make them a return. Secondly, you're finding assets or finding notes. And again, we talked about this before, but developing sources of notes to buy is an ongoing relationship-based process or activity for the most part. There are sites like PaperStack and other online exchanges. There are note brokers out there. I have a list of note sources that's ever changing. But you need to keep that fresh and keep working that. It's not something you can just let sit because things change. People go out of business, etc. So raising capital is number one. And then this is not in any particular order. These are three legs to a stool. So it's not a 1, 2, 3 as like a step-by-step process necessarily. But number two is finding the notes. Well, once you do both of those on any level, you need to manage the capital and the investors that put their capital in to the fund. How are you doing that? We use AppFolio for our software, but there's also just communication that happens, right? And investor updates. A great rule of thumb is to do an investor update anytime you do a distribution. So the investors, the passive investors, they don't just get money put into their account and not even know what that's for. They might get a quick investor update. And that's also a little bit of a marketing tool, or can be, for you as a fund manager. And maybe they say, that's right, I have this investment. Maybe I'm going to put more into that fund when they get the investor update. And then the asset management, which is kind of buried here, but that is probably, depending on what you're buying exactly, can be the most involved of anything on this slide. And that is where I would say, personally, my team and I have the most, that's our wheelhouse. We're really good at asset management, and investor management, but managing of the portfolio of assets takes a lot of work and it's not passive. So if you want to be a passive mortgage note investor and you're, either accredited or not, investing in a fund is a great way to go, but you need to make sure you trust your asset manager and your fund manager. So those are the three legs to the stool. So conclusion, is note investing passive? It can be. There's a whole spectrum of passiveness or passivity when it comes to mortgage note investing. So I don't know how well you can see this, but we have here a really cool graphic that shows what's meant to be conveyed here is that the passive investor, the extremely passive investor, can work directly with the extremely active investor. So essentially that level 1 works with level 5. Okay, so if you're investing in a note fund as a passive investor, you're trusting the fund manager, like we've already covered, to do the majority of the work for you. Whereas all the way over here, the other end of the spectrum, you're managing a fund and this is your passive investor over here. Okay, so being the money partner for a joint venture on a non-performing loan, that person, the money partner, works with the day-to-day operational manager. So these two people work together. And again, I'm just saying two people, could be multiple people. But then with multiple passive investors, that's when you get into, that's probably a fund. Selling NPLs, purchasing NPLs, those two people work together. That's transactional, but selling partials, purchasing partials. So this is meant to convey that you work together, right? Note investing is a team sport. Whether you're running your portfolio by yourself or not, you still need to be working with other people, based on your goals, your experience, the time you have. I think one of the things that's really critical to understand, whether I've really explained this well or not, is how much time do you have? How much energy do you have? I guess that's more than one thing. And how much capital do you have to put to work? Because a lot of people say, I want to learn mortgage note investing. They really don't. They want the benefits of it. They want to maybe say they're a mortgage note investor, but they don't really want to learn mortgage note investing. So, and that's okay. Maybe you buy a couple performing note loans and you say, this isn't really for me. I'll hold these, but I'm not going to scale this. But how much time and energy do you really have for this? That's critical. So there's a spot for everyone in mortgage note investing if that's what you want to do. But you really need to think through whether you want to be an active investor or not. This is kind of a lot more detail. This is a really cool slide. Definitely, I would recommend pausing this here if you can, and going through this in detail. So this goes through obviously the different levels we've covered here and different approaches within each level. So, and there are more. This is not the end all be all presentation about this. There are plenty of ways to do note investing, which we have not touched on here. But this is a really cool snapshot with a little more detail of the different, what we've covered here in this presentation. All right. And again, this is another way of looking at the same thing. And so managing a fund is very active. All these other approaches, investing in a mortgage note fund is very passive. If you go to LabradorLending.com, we have our 7 core services that we offer. The primary things that we offer are our Integrity Income Fund, which is for accredited investors. That's for passive income. Our track record speaks to the fact that we've paid monthly every month since we've opened the fund over 2.5 years ago, coming up on 3 years. That's for passive accredited investors. And then we also have our note investing mentorship program, which is for the active investor who wants to learn to be an active investor or just scale their currently active investing portfolio. And then we also have a free ebook, which has 74 pages. Truly, it should have been 5 ebooks. It's one of those things that because it's free, people don't value it. But check it out. It has a ton of excuse me, a ton of information in it. I highly recommend you start there. If you're not sure whether you're more of a passive or active investor, I highly recommend you download our free ebook, which can be found on our website, labradorlending.com. And you can see my contact information at the bottom there. So thank you so much for your time today. Fred and Tracy do a fantastic job, and their team, they do a fantastic job. They have a ton of really good resources on mortgage note investing, specifically within seller financing. And Tracy's really good with crunching the numbers. And more importantly than any of that, they're just good people. So I want to thank them for allowing me this platform, and thank you for your time. Thanks, everyone. Take care.